We've talked a lot about premium finance on this channel, and any time that I see an egregious premium finance example, I like to talk about it, because if there's one thing that can just totally wreck your financial picture, it's a premium finance policy that is, number one, improperly structured, number two, improperly communicated, and number three, doomed to fail from the start.
Doomed.
If you can avoid that, you should. And so we're going to talk about it today,
Yes.
because one of those just happened to trot across my desk. I have my partner here with me, Aaron Vincent. Aaron is actually the guy who showed me premium finance way back in the day. And I thought it would be good to get your opinion. I think you've taken a quick look at this, and
I have.
You very quickly saw the same things that I saw, but we're going to go through this real quickly, though. I'll explain what premium finance is. If you haven't seen any of our other videos on premium finance, you should probably start there, because there's way more in-depth content on that. But premium finance is essentially finding a way for someone else to pay the premiums on your life insurance policy. Now, that comes with all kinds of risks. Typically, there's a loan involved, either from a bank, or in this case, you're going to use another life insurance policy to loan against and pay into a second life insurance policy. Not necessarily the worst thing in the world on the face of it, but the devil is in the details, as always. So I've got my iPad here kind of set between Aaron and I, and we're just going to talk about this.
Yeah, let's talk about
because this is something that just has to stop.
Can I just get one thing off my chest real
Yeah.
quick? So premium financing, as Matt just did a great job of explaining, is somewhat of a complicated idea. There's multiple parties involved. If done correctly, it's great. But it really just irks me to no end. And I don't know this advisor. I don't know who showed this, so it's not personal to any one person. But when an advisor or an agent uses a complex idea to take advantage of a potential client, it bugs me to no end, and I know it bugs you as well. And all I can see in this example is that very thing. I can't, and we're going to get into the details, I can't figure out why anyone would show this other than there's an additional layer of complexity, and the client, there's no way the client can know what questions to ask to figure this thing out, and that just bugs me so bad.
It bugs me too. All right, let's talk about this. So I'm going to try to explain the structure of what's going on here, Aaron. The first thing that it looks like is in this first column, we got client contributions and income. So we got two columns here two ideas in one column. If it's got the parentheses around it, that means you're paying. If it doesn't, it means it's income. Well, let's explain what we're looking at here. We got $150,000 being paid in over 2 years. And it appears as though in year 10, we're going to start taking out some money. It starts small, and it slowly escalates up to the point where, at 60 years old, 25 years down the road, $205,000 a year. I assume this is tax-free because this is a life insurance policy.
Yeah.
Well, that's pretty darn good. It only goes up, and I only paid in $300,000. Aaron, I want this.
I bet you do. If this existed and it was real, I would say you should get this.
Well, what do you mean?
Well, so we're looking at a set of projections here that have been manipulated in a very crafty way by whoever developed this.
Well, I don't really see any projections. I just see like an Excel spreadsheet.
Well, let's start with one glaring projection that's nothing more than an assumption, and an assumption that's made every single year for the duration of the policy. And that's that darker column right there that shows 2%.
So the first column is going to be how much you're putting in and how much you're getting out. This second column is the spread. So they're not showing us the cost of the funds to borrow, because again, this is a premium finance policy. There's a loan involved. They're not showing us the cost of the funds. They're also not showing us the performance of the policy.
Correct.
All they're showing us is the spread between the cost of the funds and the performance on the policy.
Just to be crystal clear on what you just said, they're leaving out both sides of the equation. What's the cost and what's the policy performance? And they're just giving you what they assume to be the difference between the two.
Now, why is that a problem? Because all I care about is the difference.
Correct. The problem is because no one knows what either side of that equation will be year over year. And so therefore, no one can know what the spread will be.
Seems like a problem.
It's a problem.
Okay. All right. So that's what the spread means. The difference between the cost of funds and the performance on the policy. They're not showing us either of the variables. They're showing us the net. And both of those are variables.
Yes.
Which means they vary.
Every year.
Every year. Okay. We've got the end of the year loan balance. We've got the total cash surrender value. We've got our net values. And then we have our death benefit, our net death benefit here at the end. So right out the gate, if I'm looking at this as a premium finance illustration, there's a couple things that I'm going to say. Number one, this is an Excel sheet. A company did not provide this, which means, is it worth anything? I would say no.
Probably not.
Yeah, I would say no. It's probably not worth anything. The second thing, there's no cost of funds listed. There's no policy performance listed. This was not given to the client with an illustration. Major red flag. And then the last thing that I see here, just so you'll know, this loan is never paid off. So the funds are being borrowed to pay this policy. We can't see how much is being borrowed each year, but we can see that something's being borrowed because this loan balance is increasing while there's no more money going in or coming out. So there's some borrowing going on here, but we can't see the details. They're hiding the details.
Right.
Okay, if they're hiding details, that's typically not a good sign. And you'll notice that this end of year loan balance never goes away. It only grows. Okay. So those are the columns, and we've kind of touched on some of the issues, but let's just drill down. We talked about this spread column, which is kind of the second column here if we ignore year and age. Spread, 1.22%. That seems like a reasonable spread.
Yeah, reasonable.
It doesn't mean anything to you because we don't know what the variables are, but we know what it means. And yeah, a 1.2% spread, probably reasonable. But what's your problem with this column, Aaron?
The problem with the column is they start off with varying to some degree and more conservative spread projections. And then after year 5, beginning year 6, they assume the same spread every single year for the duration. And in other words, if that spread changes at all, which the irony of this is they already know it will. Otherwise, why did they show the first 5 years a variable spread? And then they just decided to stop showing a variable spread year 6 throughout. And you, the prospective buyer of this plan, this policy, the numbers on the page look good, but to say or to assume that it's going to have a 2% spread every single year for decades upon decades in a row is just completely...
It's a lie.
It's a lie. That's the word that comes to mind. It's an absolute lie.
It's a lie. And the reason it's a lie is because we can see here that this is made up of 50% whole life and 50% indexed universal life. And we know that in indexed universal life, you're going to get a 0% return, something like 2 to 3 years out of 10. And we're not seeing a 0% return. And if you get a 0% return on your whole life policy or on your indexed life policy, you're not going to outpace the cost of the borrowed funds in that 1 year.
Correct.
Now, we know that, and we're comfortable with that when we design premium finance policies because we bake it into the cake.
Yep.
Okay,
we assume them. Yep.
This is assuming that you basically never get a 0% rate of return on your index life policy.
Matt, and just to say this black and white, what you're saying here is that if your IUL, your index life policy, gets a 0, if we leave the whole life part out for a second, true or false, your spread that year is going to be -2.
Correct.
Okay.
More than likely.
Yes.
It's going to be
More
negative something.
Yes. Okay. Just to be clear, there are, as I look at this page, there's not a single negative in there.
Correct. There's not.
Okay. Good.
Yep. So major red flag, I would say fraudulent. That's a pretty strong word. I would say this is a lie for sure. 100%. Absolutely a lie. Now, whoever did this is going to say, well, it's a projection. Okay. Sure.
Mm-hmm.
If that's the hill you want to die on, go ahead. So 2% spread forever in your favor, even though we know that's not going to happen, and we're never paying the loan off. Now, here's the major kicker. Let's just say that the cost of the funds on this financing design, let's say the cost of funds is 4 or 5%.
Yeah, that's
pretty low.
Yeah,
pretty low. You're going to try to borrow $257,000 because this is coming out as a loan. This is not actually coming from the life insurance policy.
That's how it's tax-free.
This is furthering the leverage from the bank, which is why this loan balance is growing so quickly, because you're not paying the loan off and your income is just more and more loans being shown at a perpetual 2% spread. So what happens if you get a year or two, let's just say, where the market doesn't perform for you and interest rates are maybe a little higher than what they're not showing you, but obviously baking into the spread here. You could have a situation where you've got an outstanding loan balance of $15 million that's going to accrue at 5% 2 years in a row. That's $1.5 million of interest.
Just interest.
Over 2 years. Now, what's interesting is your cash value is only 17 million. I say only because only is the right word, because 15.5 plus 1.5 is 17 million, which means in this example, if you get 2 years of 0%, if you get 2 years of no growth, you're potentially lapsing this whole design.
You don't have cash value.
Yeah. If you get 2 years of zeros, none of this income exists anymore. It's all gone because the loan balance is greater than or equal to your cash value.
I don't even know what to say.
I'll add a caveat to this little discussion. We do recognize that half of this is being backed by whole life, which means there will probably be some form of a dividend paid out. But the whole life is not going to be able to outpace the cost of the borrowing by itself.
Right. Also not guaranteed.
Also not guaranteed. So Aaron, at the beginning of this conversation, I told you I wanted this.
Do you still want it?
Well, I mean, I want this. I want this income. Can I have it?
Not with this plan or this funding. No, Matt.
But I want it like this. I want to put in 300 and I want this income.
Right.
It seems relatively riskless.
I hate to be the bearer of bad news. This is completely and utterly a fantasy.
Yeah. This is a dumpster fire.
Doesn't exist.
I would agree. If you guys are looking at premium finance designs and it looks maybe a little bit too good to be true, that's a little bit of a red flag. Yeah. If you're looking at a premium finance design like this and you don't see the cost of the funds, if you don't see the policy performance, if you don't see illustrations on company letterhead backing the Excel spreadsheet that could be totally manipulated, major red flag.
Yeah. A good question to ask would be to your agent or your advisor, can you explain to me the likelihood of this spread happening year over year? Just a simple question like that. And just see how they answer it.
Is this spread of 2% guaranteed?
How do you determine, Mr. Advisor Agent or Mrs. Advisor Agent, how do you determine what the spread will be?
Great question. If you've been looking at one of these policies and you'd like a second opinion, you should absolutely get one because, as I said at the beginning of this call, premium finance can be great. It's something that we do. It's something that we've done for a long time. It's also something we're very careful with. It's something that you should be very careful with. If done wrong, it can be something that really comes back to bite you in the you-know-what. So if you're looking at one of these policies, you should go to our website and you should book a call with us. I'm going to direct you to leveragedwm.com. And at the top there, you'll see a little menu. You can go straight to book a meeting. You can also go to the Premium Finance tab, where we have a little bit more information on premium finance. Either one of those destinations is going to ultimately get you to the right place, which is a quick 30-minute discovery call with us, where we can look at what you're being proposed. We can chat about any questions that you might have, and either get you on the right track or save you from a huge financial mistake. Aaron, anything else to add?
No, Matt, I think that about wraps it up. It's impossible to say everything about this on a quick video like this, but for now, that's great. Signing off, this is Aaron Vincent and Matt Decker. We'll see y'all next time.